Hi, let's try and go over the exercise again. This is conversion of bonds, converting from bonds to common stock. There are two methods, the book value method and the market value method. And let's take a look at the exercise we talked about in class and try and go over it again and see how we can figure the numbers out. So to recap what we have on June 30th, 2021, we have Care Industries that has outstanding $40 million 8% convertible bonds that mature on June 30th, 2022. Interest is payable each year on June 30th and December 31st. That's semi-annual payments. The bonds are convertible into 2 million shares of $10 par common stock. On June 30th, 2021, the unamortized balance in the discount on bonds payable is $2 million. On June 30th, 2021, half the bonds were converted into the common stock, which have a market price of $25 per share. When recording the conversion using the book value method, the credit for paid-in capital of par should be, and the multiple choice question says 8, 9, 11, or $12 million. The answer is $9 million, but let's work our way through and see what to do over here. And I'll also use this opportunity to explain the market value method and compare and contrast the two. So I'll first start out with all the bonds are being converted. So I have $40 million in bonds and they're all being converted. So I'll start out by saying bonds payable debit. I record $40 million, all of it's being closed down. I had bond discount that was unamortized, $2 million. So that $2 million also needs to be amortized. I've skipped a line over here and I'll tell you later why I skipped a line. It's more because of the market value method. So I have bonds payable, the contra liability account, the bond discount. I need to close that down as well. And I have common stock, $10 par. Okay, I'm issuing 2 million shares, $10 par, 2 million times 10. I have $20,000. In the book value method, I ignore the market price of the stocks at the time of conversion. So it's $25 per share. I ignore that number. So I have all the information I need over here. Now what I need to do is make sure my debits and credits add up. So I have $40 million over here. I have 2 and 20. Obviously, I'm short over here, and I'm short by 18. This number is how much I'm going to credit paid in capital in excess of par. So I'm crediting $18 million. I'm ignoring the market value of the shares over here. Now, in our problem, they said half the number of bonds are converted. So what I need to do for the purposes of this exercise is the same journal entry, but all the numbers should be divided by 2. So I've gone ahead and done that. And the question asked, when recording the conversion using the book value method, Care should credit paid in capital in excess of par, and the answer is $9 million. So that's our answer over here, $9 million, because we're using the book value method. We ignored the $25. So bonds payable at face value are debited. Bonds discount, whatever's unamortized is going to be credited. Common stock, if there is a par value, it can be credited only to the extent of par value. And that's over here, 20 million. 2 million shares times 10. The balancing figure is paid in capital in excess of par for 18. Now, how would this be different if I were using the market value method? Well, I do need to take into consideration the market price of the stocks at the time of conversion. So let me see what's going to stay the same. So let's start out with, I'm basically closing down the bonds payable. That has to be bonds payable debit. That's not going to change. The bond discount, the unamortized portion, that has to be closed down because the liability is closing down. That's going to stay the same as we had with the book value method. I am giving stocks. That's also not going to change. Common stocks I am giving, and how many am I giving? 2 million. Par value is 10. That stayed the same. Okay. So far, everything you've seen over here stays the same. Now what's different is the paid-in capital in excess of par is this $25 minus 10. So paid-in capital is credited at market minus par. Market is 25, par is 10, so this is $15. So 15 times 2 million shares that I issued, this is $30 million. Now that I've taken care of everything, I again look and see how my debits and credits equaled up or not. Obviously, the answer is no. I'm short on the debit side, which means I have a loss. I have a loss on conversion. Here we did not have a gain or loss. In the book value method, we're not going to recognize gain or loss. You're exchanging a debt for a you in the balance sheet, you have assets, liabilities plus owner's equity. The liabilities is basically your debt financing, and stocks are equity financing. So you're changing debt financing for equity financing. It's just a swap you're doing. So in the book value method, we are saying we just move numbers from one account to another, ignore the market value. Here we are saying, no, we do need to look at the market value. And in the process, we say here we have a loss on conversion. Again, if we were following through with the problem, we will have to do everything for half because half the bonds are converted. And I just repeat the whole thing, but only for half the numbers. So all of these numbers that you have, divide by 2. So that's a simple calculation over here. Once again, what you need to note carefully is, in the problem, they're telling us we have to use the book value method. So always read through this very carefully, which method we're being asked to use. A majority of companies use the book value method, but both methods are allowed. So you do need to know how to work with both methods. Again, if it's a book value method, we are saying I'm switching from debt to equity. Therefore, I should not recognize any gain or loss. In the market value method, we are saying no. If I had sold these stocks to the public, I would have gotten $25 per share. So I should record paid-in capital in excess of par to reflect that market value at the time of it, the stocks being given to the bondholders. So this was an exercise that the exercise in class today that I kind of, I made the mistake of not looking at the words book value, and I discussed the market value when I was supposed to talk about the book value. So I hope this clears the confusion.